Hey, what's going on, everybody? How you doing? Did you get that mudding done already? Are you procrastinating? I hate mudding. The last time I was doing that was during COVID. I was trading. No, it was pre-COVID because I was trading in the ES in the middle of the day, and I was drywalling my bathroom. So I would come in and wiggle the mouse to wake my computer up, look at where my trade was, see if I needed to adjust anything, and then go back in, go back to mudding. You, it'll be there tomorrow, I promise. Yeah. All right. So we had a discussion topic today on butterflies. That's going to be where we're going to look. We have an old one that was placed, and they wanted to kind of better understand why didn't it work, and then a market that we can actually look at to see if we were going to put one on. How about Google? So we're going to look at Google today for our example of putting on a new trade, and then we're going to examine an old trade and perhaps maybe why it didn't work. But before we get into all the trade parts of a butterfly, we got to make sure everybody understands what a butterfly even is and why you may or may not be interested in trading them. Some options trades are very sensitive to how they function in time. A vertical is a vertical. It will behave the same whether it's 6 weeks out, 6 months out, 6 hours out. But some things are very different if they have more time. And a butterfly is one of those that is very different. So if you have never run a swing on a butterfly that had 6 weeks, 6 months, and you haven't seen the way that they can grow and mature as a trade, and you've only run a short term butterfly, then you've only got one experience on butterflies. And you have to really try them both to come to appreciate their value. So, what is a butterfly? A butterfly is two verticals. What's a vertical? When we got options trades, we can sell an option to open, and then we can buy an option to open. So, if I am building a spread with 740 and 750, if I buy the 740 and I sell the 750, I got a vertical there. And if that was calls, then I'm looking at a long call vertical. But what if I wanted to sell this spread? So I can sell the 740 and I can buy the 750. And now I've got a short call vertical. I need price to stay underneath this, right? So this is a sale and this is a buy. And that is a short call vertical. But we can add to this. We can trade the other side of the trade. So we can have a short call vertical, and then we can have a short put vertical. And if we stack them on top of each other where the shorts are overlapping, then we get a butterfly. So let's build one and see what it looks like in the options chain and maybe discuss how it got its name. I don't see the butterfly because I'm not artistic. I really am not artistic. Maybe I'm a little autistic, but I'm not artistic. When we go to buy a butterfly, we'll just use the machine here. I'm going to tell it to give me a butterfly. Since I was on the call side, that's what it did. So the middle is 681, 680, 682, right? This is the butterfly. So you can see in the middle, the short side, we got two of them. 2 short, 1 long, 1 long. It's always that ratio of 1 to 1. 1, 2, 1. That's a butterfly. And it's always short in the middle. The phrase is sell the body, buy the wings. Sell the body, buy the wings. Wings. I'm telling you, I don't see this butterfly, but let's do it the way they teach it. So 685 is our body, 680 and 690 is going to be where the wings are. I got to scroll a little bit. I didn't have enough showing. So we're going to make this butterfly $5 wide, 685, sell the body, buy the wings. So there's 80 and there's 90. The way that they show this so that you can quote see the butterfly is the body is here and they just kind of make that oval. I'm not artistic, so you just giggle later. And then that would be the wings. And therein is the there's the butterfly. I don't see it. Like I said, I've never seen it, but I can't draw pretty little butterflies. But the wings are the long side of the trade, and the body is the short side of the trade. When we go to put the trade on, if we sell a 685 and we buy a 680, that's a long call vertical. I need the market to go up. But if I sell the 680 and I buy the 690, that's a short call vertical. I need the market to go down. When we put those two together, it says I need the market to stay right there. And if it'll stay right there, this trade will make money. So let's put that butterfly on, or at least send it over to the Analyze tab. Butterflies are one of the lowest risk dollar trades that you can get. Now, when we say risk, there's two kinds of risk. There is the idea that something is risky, like say cliff diving. Man, that's some risky stuff. And then there's, well, how much money do I have at risk? So when somebody is talking risk, you really got to understand, hey, which one of those two riskies are they talking about? If it loses often, well, that's risk. And then if it has a lot of money at stake, well, then that is risk too. Butterflies are risky because they lose often. They have a very high loss rate, but they are not risky in the sense that they are one of the cheapest trades to put on, and you can really keep your loss to a small dollar amount. This is the shape of a butterfly, and 85 is our body. So I'm going to just zoom in here until we see 85. There it is. That's the body. We sold the body, we buy the wings. 85 is the sweet spot. If price was to close at 685 at expiration, this trade would make the most amount of money. But there's a couple of issues with that scenario. One, if the trade does not have a long to live when you start the trade, and by long to live, I mean less than 7 days. If it is a week to expiration and you start a butterfly, you will almost need to play chicken with the market in the last 2 hours of the last trading day for you to see any profit. Think about how difficult that is. I need price at 685 at 3 o'clock in the afternoon on December 19th, or this trade will not be profitable. Damn, that's very specific. Now, granted, if I'm anywhere inside the window at expiration or near expiration, I will start to see some kind of profit. The window being this lower break even down here and this upper break even here. If we're anywhere in this tent within that 2 hour window to expiration, we'll see some form of profit. But if I wanted, max profit 685, it has to be in the last 2 hours of the last day if it was a short duration butterfly. And that makes it very tricky. So, why would anybody want to trade this? One, your risk is really low. This trade, for an example, is risking $2. That's two pennies. That's it. You can't get coffee at McDonald's for $2 anymore. You know what I mean? Like that's some really low risk trade. Now maybe you got commissions, it's going to bring your price up to like $5 when you get commissions in there maybe. But still, that's a really low risk trade. You have the opportunity to make $95, 98 really, but commissions, $95 and only risk 2. That is a fantastic risk reward. And if you're wrong, screw it. You're out $2. What do you care? Right? Like I don't want to lose. I'm pretty sure you don't want to lose, but it is such a small amount that you don't lay awake sweating at night wondering what the market's going to do because it's going to break your account. And that's really nice. That's one of the great things about butterflies. In their unaltered state, they become bullseyes in the market. So if we go out and we look at a stock chart, if I think SPY could go to the lows down here, I could put on a butterfly down here. Now, granted, I could just, buy a put, but a put is expensive. That's a couple of $100s. I can just put a butterfly there and risk 2 pennies. If I think it's going to go, I wish I could take that kind of stuff. One, I fall asleep like a baby. I really do. I'm instantly out. My head hits the pillow. But two, that stuff leaves me all messed up the next day. And I can't stay asleep anyways. Like I get up randomly at 3 in the morning, and not because I'm an old man and I gotta go pee. I'm done. Like I wake up and I'm like, okay, I guess I'm getting up at 3 today. I don't care. I just come in and get some trades on, but I can't sleep to my alarm most days. I get up before the alarm because my body says, "Hey, we're done. Let's go. Let's go get some work done." So butterflies are nice because you can target where you expect price to go. And in the short term, it has to actually go there in the day of expiration, or you're not going to make money. But if you get a swing trade in a butterfly, something with some duration to it, 3 weeks, a month, or anything more than, say, 10 days, if price even begins moving in your direction, you should start to see benefit. I'm not saying you'll make wow money, but the trade will begin to be profitable even before price gets inside that window that we were talking about. I'm going to zoom out a little. We won't be able to read the numbers, but I just want the shape here. So when I zoom out, if price is way down here at 680, and I think we're going to go up and I build a 685, and it's a month out, as long as price even begins moving in that direction, this trade will begin to become profitable. And that's what's really nice about a butterfly. Now, obviously, the faster something moves or the slower, the more engagement or involvement, the more everything changes because options, contrary to popular opinion, options are not directly connected to the stock price. The price of the option will vary based on all kinds of factors, including how many times that option was traded today, how fast those trades took place, how many contracts per trade were traded in those trades. All of that affects the price of that option. And that is overlooked by so many people who fall down the Greek rabbit hole, thinking it's all about the delta and the vanna and gamma. But while that is true, If they come in hammering the hell out of that option and trade 45,000 contracts in a single day, then that option is going to change radically, even if the stock price doesn't change at all that day. So there's a lot of things that can alter the price of the options. Then we have to worry about the spread itself. If we build a short vertical and we build a long vertical and we stack them on top of each other, one is losing and one is winning. If it's over our head in the scenario that I mentioned here, when we run higher, that call vertical that is short is going to begin to lose. But the call vertical that is long is going to begin to win. Now, as long as we don't overshoot the short vertical, then it won't, quote, go into loss at expiration. But if you've run short verticals before, any of you sell premium, you know as soon as the market even looks in your direction, your premium trade starts to lose, right? They just start to go negative like bad fruit. So if we move in the direction of that short vertical, it will immediately begin to lose. But if we are doing it nice and easy, not too fast, no big hurry, it won't freak out and the loss won't get extreme. And you'll start to see the long vertical grow faster than the short one is losing money. And that trade will start to profit. Now you can work the order on options and try to get these filled at any time. So if you bought it for $2 and say you have 10 of them, you could start to feather out your exit, maybe putting one in at $15, $25. What do you care? You got 10 of them. Feather your exit out. If you bought, say, 10 at $2, you've risked a total of $20 and you close one butterfly in a $20 profit. Well, now you got the other nine for free. They're already covered. You can do whatever the hell you want with them. It doesn't matter because you've already paid them off. And then you can try to get runners, see how many you can get to, you know, various profit targets along the way, and keep feathering them as long as the market continues to work in your favor. You have to realize how much these things are affected by time because the vertical that is short is a pure time play trade. So if you're building it over your head and it's an upside target, for an example, that short call vertical is going to get punished by the upside move. That's just the way it is. But once the market quits moving up, once the market quits moving quickly, that short vertical will dial back some of that loss. And for every day that goes by, you get the theta priced into it. It's not going to be as ugly as it looks in the P&L at the time that you're looking at it, right? As time goes by, that P&L will change. And remember, the max loss is what you paid when you bought the butterfly. It won't get any worse than that. So, worst case scenario, you already know what the maximum penalty is going to be because you paid for it when you opened the trade. There's a lot of ways nuanced. We'll save that for later. And there's ways that when we go to put the trade on, we can point it at different directions. This one, we didn't point. It is a bullseye, and we picked the target in time and space, and we said, I believe price is going to be there, and I'm going to put the butterfly on in that spot. But we don't have to necessarily pick one single spot. We can pick one direction. And as long as price doesn't go the opposite direction, we'll make money. That's a lot easier when we're thinking about how hard it is to trade. Is it going to go up or is it going to go down? How far is it going to go up? How long is it going to take to make that upward move? And when it gets there, is it going to hang out there or is it going to fall back down again? Those are really hard things to figure out. But if you instead try to figure out what's more likely, that it goes up from here or down from here, in the next 6 weeks? And how likely is it that we don't close below some line in the sand? I think you'll find that that's an easier question to answer. Not always, obviously. Some markets are tricky, but if we have a consistent low that has been tested again and again and again and again, and then we're headed down into that low again, maybe when we hit that low and start to rise off of it, and we put on a trade that says, I bet we don't go lower than that low over the next 6 days, that's probably going to be a lot easier to trade as opposed to saying, I bet we're going to go to this particular price at this particular time. So when we point a butterfly, that's when we shape its direction to where as long as we stay above or stay below a certain level, we'll see profit. That's nice, to be able to shape them in that way. So these trades, you never want to sell to open a butterfly. Technically, you can do that because the button is there, but you never, ever, ever want to sell to open a butterfly. I'm gonna shape a sell to open butterfly so that we can look at it and talk about why you never want to do this. But in the options world, we do have choices, right? And we can choose to sell to open or buy to open. This is a sell to open butterfly. My maximum profit is $1. That's 1 penny, by the way. And my maximum loss is $99. I am not interested in taking a trade that risks $99 for a chance to make one. Even if it was 80-20, I still don't want this trade. If we get into the valley of death here in any way, shape, or form, we're going to be losing in this trade. This is just a really bad trade. So you never, ever, ever want to sell to open a butterfly. Not a directional one, not anything that has this valley of death in it. All right. So buy to open only. And while there are mechanics to manage a trade like a butterfly, we can roll them and split them and do all kinds of things. What I always recommend to people when it comes to butterflies is make it the size that you're willing to lose and assume when you pull the trigger that it will be a max loss. Just assume that from the get go because maybe, yeah, it is. Maybe you're going to be able to roll it and adjust it because it's possible, but we can't count on that. Sometimes it's not possible. So don't think that you can, and always build it at a price that you're willing to lose. And I got to tell you, I don't care about $2. All things considered, I don't care. I put these on every day of the week and never even worry about it. It's $2. Now, if it was $200, $2,000, well, I mean, you got my attention, right? So build them at a size that you're comfortable losing because you cannot make the assumption that, well, it's okay, I'll just fix it if it goes wrong. Maybe, but that's not guaranteed. So now that we know what the shape of the butterfly is, we know how to open them, and we know that we can target higher levels. We don't have to build it where price is right this moment. We can now talk about shaping them in different ways. We didn't cover this one piece though, this trade that was here. Now, this was a December 19, 300, 310, 320 bought to open for $1.67. What do we know already? That it's $10 wide and that it was risking $1.67 for a chance. Let's round that up and say $1.75. It was risking $1.75 for a chance to make $8.25. Now that's a really awesome risk to reward there, right? You're basically risking 2 to make 8. Sounds good to me. How likely is it that the trade is a profitable trade or not a profitable trade? Well, probabilities, we'd have to look at where the deltas were at the time. You know what I mean? Those kind of scenarios, how far out of the money it is, how far out in time it is. But when we go to put on the trade, if, like I said, it's far out in time, if price gets to your target 2 days after you put it on and it has 20 days left to go, you won't have any money in it. It can go right to your bullseye and it will probably show a loss. It won't even show a profit. And that really sucks, to have price go exactly where you want it to go, but it got there early and you didn't make any money. So the question right now is 680, 690, and 700. Remember that the 690, or the the body, is what we sell. So here's 690. We want to buy a butterfly, and of course we just adjust all of this once we tell it what we want. So from 690, we got 680, and then we've got 700. It's a $10 wide butterfly, $2.50. So it's about 25%. We're risking three to make one. Wait, I said that wrong. We're risking one to make three. I had that completely backwards. Risk one to make three. That's also really good, all things considered. Risk one to make three any day of the week. Now, how likely is it that this trade is going to work? Well, we can start with the delta. How likely is it that SPY can reach 690 with 16 days to expiration? There is a 40% chance that SPY will hit that between now and expiration. How do I know it's 40? Because it's a 40 delta. Delta is an old school function of probability. If I brought Tasty up, it would give us a different answer because they use a Monte Carlo level simulation for probability. But old school, off the cuff, I'm in a hurry, I'm in my zone, and I just want to see, what's my odds here? 40% chance that we bullseye this thing. But bullseye is not needed for profit, right? So I don't care if I bullseye this thing. Just how likely is it that I can reach that target? Because I'll tell you, if the chance of even reaching the target is like 15%, that's not going to work for me, right? Because this is a risk one to make three. I need to make sure that I can have the same kind of loss rate that can match that risk to reward. And I used to have a cheat sheet for risk reward and win rate. I'll have to dig that back up. You can do the math too. Nowadays you can just ask AI, if I'm risking one to make three, um, what's the win rate required to keep the portfolio green? And it'll tell you. So with this trade, some things that we can answer before we even decide to get in is, can price actually reach the center of the butterfly, 690? Yeah, we got a 40% chance that we can do that. What about one of the edges, 680? Hey, no problem. We're already inside of that, right? So we don't have to reach 680. We just need to stay above 680. What's the likelihood that we stay above 680 into expiration? There's a 60% chance that we stay above 680 into expiration. So this trade has a 60% chance of closing above 680. That's a good number, right? 60%. It sounds pretty good. But remember, we can't overshoot the trade. How likely is it that we overshoot 70 or the 700 target up there? We got to stay underneath that level. There's a 20% chance that we hit that. So we have a 20% chance of losing with a 60% chance of winning, or at least staying above the 680. And if you dial those two together, subtract the 20 from the 60, you're back to 40 again. 40 is what we had for that out of the money centerpiece 40 delta. This trade has a 40% chance of winning. Now, if you're young to probabilities and you're thinking 40%, that doesn't sound very good. Well, the thing about options is if it's a surefire thing, if it's a 99.99% chance that you're going to win, guess what? They won't, there you can have that if you want it. They're out there all day long. You can pick a 99% winner, but there won't be any money in it. Why would there be? If you have a 99% chance of winning, who the hell's taking the other side of that trade? Someone who has a 99% chance of losing. If they actually did win, shouldn't they get paid for it? And if you win, why should you expect any money? Think of winning the lottery. You know, 1 in a million chance, right? One in a couple of million, 100 million chance. So if you actually do win the lottery with that 1 in a million odds, you get paid, right? Why? Because you got such a low odds of actually winning. So you don't want trades that have 85, 95, 99% chance of winning. A 40% win rate trade is not bad at all in the options world if you can add a little edge and handicap the position. How do we handicap a position? Well, the odds are connected to expiration. You can close the darn thing early. That's handicapping the position right there. The fact that you don't have to hold it all the way to expiration, that is a benefit of yours. So, yes, a butterfly is time sensitive, but if they're far enough out in time and price doesn't freak out on its way to your destination, as soon as price begins moving your way, you should see a little profit. At least it shouldn't turn negative. And as time goes by and that theta decays, if you're inside the tent, you'll see that profit start to materialize. So you can see profit at a greater success rate than 40% simply because you have the right to close the trade at any time. Then we can handicap the trade even more by making sure we do it against optimal levels like serious support and resistance or call walls and put walls or double gamma levels or you know what I mean? Like we can add all of these extra things that give us more surety that the trade is going to play out the way we expect it to, and that increases our odds of success. So 40%, while it doesn't sound like very much off the top, 40% is why you even get $250 to begin with. Because I promise you, if I build you a 99% chance of winning trade, it will have a much lower profit amount. It, what that means in butterfly terms is it would cost us $950 and we'd have like a $50 profit window, right? Well, who the heck wants to risk 950 for a $50 profit window? Not me, right? So don't let the probabilities scare you away. At least now you know how can I check my probabilities? Look at your delta. If you don't want to use the delta, because I get it's old school. Maybe you want to use something a little more modern. They have touch, probability of touch. And it's just like it sounds. How likely is it that price touches that level? It doesn't mean close at that level. It's not using quote at expiration, but it is using between now and expiration. How likely is it that price touches that level? That's useful. Turn that on depending on who your broker is. Not all brokers have that. I'm a little I'm a little concerned about the job numbers to be honest. The forecast, well that word was like smoke. I couldn't grab it. The forecast for ADP was positive, and we ended up negative. Look at that. It was a plus 40, and we were minus 32. It wasn't like a little off. It was oh damn off, right? Like oh damn, dude. If they got that wrong, how bad is tomorrow gonna be? Eh? There was a post that I was reading today that said, "Hey, AI is not to blame for all of these companies laying off workers. The lack of spending by customers is the reason that all of these businesses are laying off employees, right? The um the spending for Black Friday and Cyber Monday was not wow numbers. I don't have the numbers in front of me, but they weren't good. They weren't like horrible, but you know what I mean? Spending is down, and that ties back into people are becoming price sensitive. Companies are not selling their wares at high levels. They're selling their wares at higher prices. And that's the reason that they're even making their earnings for those that are. It's not because of the frequency, it's just because of the cost. And when buyers become more price sensitive, they're going to quit buying as much. And the buy now pay laters, the numbers are up on those. People are using buy now pay later for their groceries. That is not sustainable, That no. That's not sustainable. So there's some big risks coming. Will we see it in the job numbers this week? I don't know. I don't like how bad the surprise was today. And on the other side of that, I don't like the lack of reaction to the surprise in today's numbers. Because this fall was not from that numbers, right? That was like Microsoft. So the market saw that we missed by a huge margin and was like, so what? Really? That's not cool. Not even a little bit cool. So when it comes to trading in front of economic events, rather than trying to think we can game that system, because we really can't at the end of the day, what we can do instead is either accept the risk and do it anyways, or we sit out. And I get it. Sitting out is not what people want to do, right? We didn't learn how to trade just to not trade. But those are really your choices. If you trade in front of an event, you are trading in a higher risk environment. And that's the end of the story. Like you can buttress that as much as you want, but it's still, I'm willing to take higher risk. Oh, okay, sure. You should totally trade in front of that event. Me, I like my money. So I don't. What I used to do is I'd say, "Oh, it's okay. I know how to roll these things and I'll roll it, convert it, flip it, do something else with it. I don't care. I'm going to put it on anyways." And that's true that, most of the time you can do those, but not all the time. Not unless you're willing to increase your risk much greater than the original risk. And you just kind of get to the point after a while where you're like, that's a lot more risk than I'm willing to take. But it's only $2, Oh, so what? It's only $2. Yeah, I mean, if you can risk $2, but we're looking at a $250 trade. Are you willing to shrug off $250? That won't break the bank for sure, but it's certainly going to be stubbing your toe in the dark in the middle of the night. You're going to feel it, I would think. That's always a really good question. Oh, you nailed it right there. Is this a trade that I would be willing to put on every day? That's a really good question to ask, too. Yes. Because the other side of that is, could this be a trade that I could put on 1,000 times? Because that's where our probabilities come from, right? If I did this trade 1,000 times, would I be more or less profitable after 1,000 trades? Well, the other side of that question is exactly the one that was just said. Would I be willing to do it every day? But me, it's a high risk environment because we know that we're getting some shenanigans in the job numbers, and the market did not respond to the huge miss that we just got. And I will refuse to put my money into it because I like my money and I don't want to give it away. We can beta away the portfolio to minimize that risk. We can always close the trade down if it's not working out. We can roll them and adjust them and manage it in some way if it's beginning to lose. But the best way to make sure it all works out in my favor is just not to get into additional risk when I don't like it. And I don't like it. How about you do the same trade at a smaller size? Maybe you're okay with a $250 loss. If you are, you should totally put the trade on. You know what I mean? Like, I'm not being glib in any way, shape, or any way at all. I am 100% sincere. I shrug a $2 trade any day of the week. Like, I don't care. I'll put it on or whatever. Let's see how it get. It's who cares, right? It's $2. If your sentiment on 250 is the same as my sentiment on $2, then you should totally put the trade on. And I have a couple of clients with $1,000,000+ accounts, and they shrug $250 trades off all the time. And it makes me cringe when they do it, but they just don't feel a $250 loss. So rather than me speaking out of turn, if you're comfortable with 250, then why not put the trade on? Otherwise, you can make it smaller. You can make it, $2 wide or $5 wide. You could change your target parameter. You could even change the time of the trade to make the risk not so big, so that it is a size that you can shrug off. And that way you can still participate. You can even go to another market. If SPY goes down, so will everything else. Not, like everything, but the idea. 80% of the market is going to follow the S&P and the Nasdaq. So if they go down, TSM will go down, SMH will go down. SMH is probably going to have cheaper options. It won't be as liquid, but SMH is what Spot Gamma likes to recommend when they are looking at SPY and the Qs to go long or short, because it's a nice proxy. It's cheaper, right? It's the same trade. It's just cheaper. So if you can shop around and perhaps find the same trade in a proxy at a cheaper price, that would be good too, right? Get that risk down, make it smaller and more manageable. All of this so far has focused on the simple, very generic tent shaped butterfly. And we would sell the body and buy the wings. We can put it on where price is right now, or we can target higher with calls, lower with puts, and we can expect price to move towards our target. And that if it's a short duration butterfly, it is only likely to see profit on the day of expiration in the last 2 hours of the trading day. And I really want to hammer that home, because if you open a butterfly with less than 10 days, that is very likely what you're going to end up doing, is playing chicken with the market in the last 2 hours of the very last trading day. If it has more than 10 days, you should be seeing some form of profit if price begins moving in your direction. But now you can't get there too fast or it won't have the profit you need, right? Time has to go by if it has time to it. But what if we change the shape of the butterfly? What if it doesn't have to look like this? I'm going to put that bigger butterfly in here that we built, this one. Let's send that over to the Analyze tab and we'll hide this butterfly. So now we've got this beast here. Um, Better than 10, right? And you can move it up a little. Hey, Marziti, be careful with that mudding. Make sure you're wearing a dust mask and have a good evening. 30 is good. You know, if it was Apple or Google or something, we can't always get right at 30 days. So you could be from like 20 up and probably be okay. If the choice is, say, like SMH, I can go to 23 or I can go to 30. Yeah. Um, I like the one that has the more liquidity. I'd probably go 44 days out because this monthly probably has more liquidity than this 30-day expiry, right? So I would go to the one that has the better liquidity farther than 20 days out. If that makes it 44, fine. But if it was 23, if this 23 had better liquidity, I would be willing to at least look. But I already knew it wouldn't, so I didn't even bother with it. 44 is probably where I would end up because it's where the better liquidity is at. So let's change the shape of the butterfly. We got this SPY trade. It's $247.50, 250, and it's equal on each side. If we go up too far, we'll lose 250, and if we go down too far, we'll lose 250. And this is where the sweet spot is, in the middle. What if we could take all of the risk from one side or the other and put it on the other side? SPY right now is underneath 690. So if I took all that risk that is down here and I moved it over to this side, then I would only lose once we broke the upper edge. If we stayed underneath that upper edge, we would be profitable because we can do that, right? Here's the zero line. And right now the trade goes under zero and it comes across at $250. But we can change the shape of this butterfly so that it's actually sitting somewhere at, like, say, $50 or $100, and then it goes up and back down and goes over here. But there's a problem with this. The risk has to go with it, right? So if it was 250 here and 250 here, now it'll be plus 500 risk on this side, right? More than 500 risk on this side and no risk on that side. So we didn't get rid of the risk, we just moved it. And that's really important to understand. Yep. And sometimes you can sell these. So we can buy them for sure. We absolutely can buy them, but we can sell them too. It really it depends on which way we want to go. So with these, we're going to keep this here, but let's shop around and look at what we could find that is also $10 wide, but it is pointing to the downside, which means as long as we stay underneath 690, or actually the break even here, 697 and a half, we'll be good to go. So what I want to do is we'll just copy this, put it over here. There's our trade. There's two ways that we can adjust a butterfly. We can change the ratio from a 1-2-1 and make it into a 2-3-1 or a 1-3-2. We call that a ratioed butterfly because, well, we're messing with the ratios. Or we can leave it a 1-2-1, but we can change where the strikes are located so that they're not equidistant anymore. Let's send this over and we'll hide. Let's just hide the bottom one. They're both the same trade. We'll hide the bottom one and we're going to kick the 700 down to 95. Now, as you can see, I pointed it to the upside. Oops, we went the wrong way. So let's put that back at 700 and move the other side up 5. Now, there we go. That's what we were looking for. We pointed it to the downside, took all of this risk, that $250, and we moved it over here. We did not get rid of that risk, right? We just moved it. So now a loser is going to be $424. That's not bad. I thought it would be $500, right? Because it was 250 and 250. So it's not 500, but it's pretty ugly. And we're opening the trade for a credit. Just like if we were going to sell to open a vertical or an iron condor or something like that. We're going to sell to open this trade, and as long as price never gets above 695 and a half, or if we don't close above that at expiration, this trade will be profitable. And it has the sweet spot at 690. The same 690 as the other trade. The most money will be made right in the middle. If we don't run, you still make $76. If we fall all the way to zero, you still make $76. So that's not bad right there. It does have a lot of risk on the upside, but the requirement is that we don't close above 695 at expiration. To make it less confusing, I always like to do it this way. You get to choose a line in the sand and make a very definitive statement. I believe price will not close above this line by expiration. If you're confident in that statement, you could put that trade on. And if you're not, what needs to change? Do you need a higher level? Do you need less time? Because, I mean, anybody think SPY is going to go to 800? I do. Not today. You know what I mean? No. But someday, yeah. So time matters. I don't think it's going to go to 800 in 2025. Maybe not even in 2026, but we will eventually someday go to 800. So if you add time to the equation, do you think we're going to go to 695 before Christmas? If your answer is no, well, there you go. If you say, yeah, I think we can get there by Christmas. All right, well, what about the 20th or the 15th? Start shortening that time until you say, oh, yeah, I don't think we can get there by the 16th. Cool. Now you know what time you need. Or look at liquidity, right? How much liquidity is at different expirations. So this is a broken wing butterfly. That's what it's called. We broke one of the wings and it is no longer equally distant. One side is $5 wide and the other side is $10 wide, but it's a 1-2-1 broken wing butterfly. Technically speaking, you shouldn't get a credit. When they teach these in the options courses, they say if you want it pointed to the downside, use puts and buy the butterfly. And if you wanted to point it to the upside, use calls and pay the debit, right? Remember what I did earlier? It was instinct because that's the way they teach it. This is a real broken wing butterfly. It is bought to open and we use calls to point it higher. But, me being me, I'm a big fan of options and just the idea that we can do whatever the hell we want. And I like to do it the other way around. I like to sell them to open, but you don't have to. So if you are taking some class or course and they're asking you about the broken wing butterfly, this is your real answer. You use calls to go higher, you use puts to go lower, and you always buy the butterfly. But, real world, real traders, you can do it the way that I showed a moment ago. Sell to open like that, right? So this is using calls to go short, and we would use puts to go long, and we can sell to open on both of those, and it's a broken wing butterfly. But what's the difference between a broken wing butterfly and a ratioed fly? So we'll just copy this trade again, bring it over here. Actually, I didn't need to do that. I guess we'll just send that trade over. We'll turn this one off and that one off. I guess we'll do it that way. All right. So there we go. We are back to the regular $10 wide. It looks like a tent butterfly. So we need to adjust this. Instead of a broken wing butterfly, we want to run a ratioed fly. Why is it going to work for us? Well, if you remember the way the original butterfly was built, there it goes, a little bit of a delay. This is a 1, 2, 1, and we're building one long vertical and one short vertical in the same trade. What if we add one more vertical on top of one of these verticals? So, a good way to explain that, let's look at 680 short, oh, excuse me, long, and 690 short. That is a long vertical and it's part of the butterfly. But I don't need just one. Let's get two. Ta-da! Now I've got two verticals right there. Now I want to add another vertical and turn this into a butterfly. So I'll sell that one more time and I'll come out here and I'll buy that. Now we've got a 2, 3, 1. Which direction is this pointed? Before we even send it over to the Analyze tab, which way do you think it's pointed? To the upside, right? Because we bought two long verticals. We didn't have to, though, right? We could have sold two short verticals instead, and then it would be pointed to the downside. So let's send this over to the Analyze tab. We'll just turn that one off. And look at the shape of that thing, huh? Well, that looks very familiar, doesn't it? Let's zoom in on that a little bit. It's not the same trade because look at the risk. $873 in risk. Ooh, that gets a little bit expensive. Do I have something else open down here? Nope. Just checking. Just the one. So that is a ratioed fly, and we are risking $900 for a chance to make $100. That's a lot more risk, but it is the same trade. Oh, I doubled that. No, I didn't. I didn't. We're good. So, go ahead. That is a really good question. Um, I have a couple of avenues to answer that. So hear me out all the way through. On the one hand, there are a lot of well known, very famous, very popular traders who tune everything out and they only look at the chart. And they do very well. And they are popular, they are profitable, and it works. On top of that, there's a lot of trading psychology books that say how interesting it is that if we turn this into a line chart and ask a child where it looks like that line is going, they don't quiver or hesitate at all. They will say it looks like it's going up. It looks like it's going down. Very simple, very easy because they don't overthink it, right? They don't put all the extra fear and angst and news and they just look at it and say it sure looks like it's been going up. It's probably just going to keep going up. So those are interesting antidotes. On the other hand, there's also the fact that we should be very aware of landmines that we can easily avoid. So if I know, for an example, that they are going to have a big news event tomorrow that might seriously alter the landscape of the market, why would I want to participate in that big unknown? Like earnings, for an example. Why would we just ignore this huge risk and trade that? So yes, they're not wrong. You can 100% tune out all of it and just trade what you see. Because with a good risk to reward and a good win rate, your account will survive and grow. And that is truth because that's the numbers. But I don't like forced errors when we back ourselves in a corner and cause us to lose simply because we didn't step over something obvious. That's a forced error, and we can avoid those. So, why wouldn't we want to avoid those? The problem is there's so many kinds of people out there. And if you get someone who ends up with lockjaw or analysis paralysis, where they say, gosh, every time I go to put on a swing trade, there's some kind of risk in front of me. I've got earnings and dividends and FOMC and QRA, and every single trade I go to get, there's something else there, and I don't know what to do. I can never get a trade. You're gonna have to tune that stuff out, bro. You're gonna have to do something. But then there's others who are a little more nimble and weave in and out of those risks and find ways to manage it and make it acceptable. They're not steering you wrong. The answer just doesn't fit everybody. And you should try to do what suits you best, or it won't work. You'll talk yourself out of a trade. You'll stay in too long, get out too soon. We all do it. If we trade too big, if we trade against what we know to be right, we make bad decisions. Yep, yep. It's a really good question, though, because I think at some point we've all struggled with that same dilemma. Like, what am I supposed to do? There's always something. There was a Yep, that's a really good example that we have these known unknowns that are coming that can radically alter the landscape. And then we're left trying to figure out, was it worth staying in? To me, I can always find a trade. That's one. There's not a day goes by where if I want a trade, oh, I can get it. So I don't need to keep any of the trades I have. It's not like I can't find another one. So, I'm not at fear of the lack of trades. So, with that in mind, knowing that there's another trade at my fingertips, I don't need to keep a trade in front of risk. But every trader has to come to a balance in that in some way. Some traders take that to extremes. If you guys have heard of oh shoot, I'm gonna forget his name now. He's a really popular day trader, old man. We've even had him in the channel once. He came in and he did a big presentation with us. Um, oh shoot, I'm forgetting his name right now, but he was a big day trader, and he's a futures day trader, no less. But he turns off the overnight data. No, oh, it'll come to me in a little bit, or I'll go hunt it down. He's a day trader and he uses the ES futures and only candles. No indicators, no news, no overnight, only the intraday price action and only candles. And he turns all news off. Now, if you guys have been here even a week, you know that the pre market is where I base my entire day, right? Like, no way would I ever hide data. Al Brooks, you got him right there. That guy. Now, don't get me wrong. Al Brooks is popular. He's profitable. He's well known. He's been doing this probably longer than I've been alive. But I use the word ignorance deliberately when I say if you turn your back on something that has been proven effective a million times over, stubbornly, obstinately refusing to look at it, then you're ignorant. Here, let me give you $1,000. No, I don't want it. I'm going to just turn my back. Fine, turn your back. Be ignorant, right? I don't even have a better word for it. Why would you deliberately ignore information that is right in front of you? And yet he does. And he is profitable. I can't argue that he's not profitable because he is. It works for him. I've met a lot of people who tried to trade the Brooks way, and they say after a little bit of time and effort and money, and they walk away. They give up. They say, nope. Here's one little nugget that gets lost when people start looking at Brooks. It only took him 20 years to become consistently profitable. Only 20 years. So if you wanted to commit 20 years to day trading futures before you finally find consistent profit, then maybe he's the way to go. But I'll be damned if I would ignore data that is right there in front of me over some arbitrary reason that I never did get an answer to as to why he would turn it off, other than I guess it's distracting. Whatever. I Oh, his counting system. He runs a counter. So he runs, bar 1, bar 3, bar 5, bar 7, and he counts the candles through the day, and on it goes, right? He has a system, but he is a really good example that you can turn off data or ignore data and just trade the charts, and it will work for you. But I will not. We do have to worry about information overload or analysis paralysis, where we get so much info, it's like we can't do anything at all because it seems like we're just, damned if we do and damned if we don't. And therein lies the problem. We can't go to that extreme and get too far, but we got to keep our head on a swivel, right? I've shared a book in the chat. It's an old book by Gerald Appel. I believe it's just called Technical Analysis. But in that book, he kept it really vague for the longer term buy and hold swing trade accounts, and even just adding new swings in a portfolio. As long as you were on the right side of the Fed, then you should totally do that. So he didn't get hung up on every single, jobs number and ADP and unemployment, all of that. He didn't get hung up on that. But if we were long in the S&P above the 200 and the 50, and we had forward guidance in the Fed, then your portfolio should stay long and you should continue to add to it. But when we were no longer above the 50 and the 200, and we no longer had automatic guidance from the Fed, then we needed to be more reactive to the market and more defensive, and adjust the portfolio accordingly, and not add new positions all willy-nilly. Not to say we wouldn't add anything at all, but we'd have to be a lot more cautious because the landscape has changed. I'm a firm believer in that because I don't like to lose. I want to keep my money. I can day trade every day. So I know I'm going to eat. I know I'm going to pay my bills. That's not a problem. For the longer term account, it'll grow. It'll especially grow when I'm not taking losses from silly things that I could have avoided or trading in a high risk environment. So really, it's a great question. And it's not a one size fits all answer. Um, there is a lot of arguments for doing exactly what they said. Tune it out, trade the chart. If we are in a bullish market environment, then the monthly job numbers and CPI, PPI, non-farm payrolls, they are not going to radically alter things. That is true. If you have time for it to recover and come back up again, options traders don't have that luxury a lot of times, right? We've got a set expiration, 8 days, 6 days, 12 days, whatever. And the trade may be going good. And then we have CPI tomorrow. And we're like, oh, it's okay. I've got 9 days left. CPI comes out, knocks your trade in the dirt. And before your option becomes profitable again, you run out of time. Sure, if you'd have had more time, it would have finally recovered and you would have been okay. But you ran out of time. Now you took a loss because an economic event got you. And that just sucks. So, if it's just stock and you have time, then sure, you could probably ignore things, let it ride. It'll come back up. There are communities that are buy and hold communities where they believe that always the market will come back up. Unfortunately, you get companies like UNH. Oh, it's going to come back up, right? Sure, maybe when my grandkids are my age, it might make it back to the top. But if I need my money a little sooner than that, and if I was in this long, waiting to get back to 600, I could be waiting for a long time. But it'll finally come back up eventually, probably, maybe. Zoom or PayPal or EDU, Carvana. There's so many examples where something got beat down and the long-term trader is saying, "Oh, it'll come back," and then they're not probably wrong, but how long is it going to take? So there was a question about, so this is another wedge. This is like our sixth wedge, fourth wedge in the last month. We've been getting a lot of these half day wedges again. It's cool. I'm glad we're getting them. I like them, but careful on that. So Google, when it comes to options, I am a little picky. I want things that are liquid. So, yes, you can trade anything that has options, but I don't recommend it. It's a part of that forced error that we were talking about. Trading things that are illiquid will inevitably not work very well. So, with Google, we're pretty confident in Google and its liquidity. It's Google, for goodness sakes, right? But we can't assume in this environment that we actually have liquidity. So we need to go in and look. Liquidity is not a single item. It is a multifaceted, uh, complex idea, right? It's like trying to explain. Oh, maybe I won't use that analogy. Yeah, no. You guys watch anything to do with politics, right? The old the Senate hearings like back in the 80s, and they were maybe it was 90s, maybe it was during the Clinton scandal. And they asked one of the White House aides about porn, and he said, describe the nuanced difference, if you would, with porn. And the guy says, It's porn. You'll know it when you see it." Right? Like it doesn't have this. He couldn't articulate it. Liquidity is a lot like that. You'll know it when you see it. It's not one single avenue or one single thing. So with liquidity, how do you know you have it? If it was just one thing, that would be great. We could look at volume and we could look at open interest and say it's liquid, but unfortunately, it's not that easy. We have to look at a lot of things to define liquidity. So we look at the strikes. How big are they? Google has $2.50 wide strikes. That's not that bad. Google's a $320 stock, $2.50 wide strikes. That's not bad at all things considered, right? At least it's not $10 wide or even $5 wide. So 250, it's not perfect, but it's not too bad. The narrower the width, if they were $1 wide, that would be awesome. 50 cents wide would be even better. The narrower the width implies more liquidity, right? Then, how many strikes do we have? Is there a lot of strikes in each direction? And if we do see a lot of strikes in each direction, are they actively traded, or are they just a bunch of bag holders with zeros on the bid or the ask? So if we go and look at something like this trash, you can see all of these call strikes here. We can look at it and say, hey, it's 50 cents wide. I've got a lot of strikes out here, but you really don't, right? There's no liquidity here. Nobody's trading it. It's frozen. This is just junk. Same thing on the other side. There's nothing here, right? So it doesn't matter if I have a lot of strikes on the call side. They're not traded, they're not liquid. And on the put side, I don't even have a lot of strikes. I got nothing. So when we look at liquidity, we want to try to articulate that liquidity as best we can. Is Google liquid? It has a lot of strikes and it has relatively narrow strike widths, 250. It's not that bad. When we look at the open interest, do we see a bell curve in the open interest? Think about a volume profile as it widens out in a traded area and then it gets narrow again. A typical volume profile would act that way. And where price was traded the heaviest, or for us, where price is right now, that would be where the bulge would be. So if we think about, the typical volume profile here, we'll just use this TPO. It has that same bell curve shape to it. This is where the greatest amount of trades took place. If this was options, we would say that's where the money is. If we don't have that in the open interest, is it still liquid? Possibly, but I would be more comfortable with its liquidity if I could identify that there was such a curve here. If not, what do we have? Like on the call side, is it a bunch of speed bumps? Now, this can happen for multiple reasons. Um, these narrower bumps, the little in between ones here that are really shallow, these could be newer contracts. Notice we had fives, and it's the fives that are filled. And more recently, they added halves, and those are the ones that have less trading activity. Okay, I mean, at least we understand what's going on. When this was farther out to expiration, it only had fives. So we come out here, hey, look at that. It's $5 wide strikes, and it's not very liquid. But as we got closer and closer to expiration, they started adding more strikes. And since they're newer, they haven't been traded as much as the $5 wide strikes, there's just less activity there. So, okay, cool. You know what I mean? Like we we at least know what's going on. If it was the profile shape that I had mentioned, it would imply that these mid-level strikes, the 250 wide, had been there longer, maybe the whole time. And what it instead tells us, looking at those calls, is that they haven't been there the whole time. They've only recently been added. It's not a bad thing or a good thing. It tells us how long they've been there. So is it liquid? We're seeing a lot that says yes. Lots of strikes, narrow strike width. The bid ask spread is another thing that help us better answer that liquidity question. It would be awesome if it was just 1 penny wide, but in the real world, getting 1 penny wide is really hard to do. Even getting it in SPY nowadays can be difficult to get. So, 3 to 5 pennies isn't bad. 10, okay, I don't like it. When you start getting above 25 cents, 50 cents in the bid ask, you're getting into some dangerous territory. I've seen traders trade things that had $5 wide in the bid ask. $5. Not 5 pennies either, but literally $5. They were making their own liquidity at that point. So, yeah, Google appears to be liquid. I'd say we could start shopping around for a trade. And if we did want to put a butterfly on here, well, how far would we want to go? Me personally, we got two choices, and it's not a dichotomy of we have to choose one or the other. We could do both because one will be so cheap that it won't matter. Let's go to the stock chart first to begin answering the question of, well, if we were going to trade this, do we want a short duration or a long duration? How about both? Because the short duration will be so cheap. It'll be one of those penny trades where we're like, shoot, why not? It's just a couple pennies. What do I care? Yeah, put that on. But then we also want our longer term one, right? So, what could we anticipate here? We are on December. We're just in there. So, it's a new monthly bar. I know I'm all the way out on a monthly. Oh, my goodness. But there's some relevant information out here. Where is the monthly close and then the monthly high, which was all-time high, and where is the monthly low? Let's come into the weekly now, and we can see something really awesome and a little bit dangerous. We have a weekly gap. Now, a weekly gap is a real beautiful thing, not an earnings gap. Don't count that one, but just a gap. You really don't want a weekly gap at the highs. You really don't. Most of the time, it does not work very well for the gapper, right? Because when you talk about a gap, you got different kinds. You've got gap and goes, breakaway gaps, exhaustion gaps, reversal gaps. There's all kinds of gaps. When we have a gap up at the highs like that, typically we would anticipate that that's going to be gap and crap is the great term for that. That it's a fake break fast failure, and that we're going to come crashing back down again. We didn't. We gapped up there and we held it, which was a bit of a surprise. And again, don't count this gap, right? Because that was an earnings gap. So from the highs, we gapped up, and here's how bullish it is. It has not come back down and tested that gap. That's really bullish for a market to do that from the highs to gap up even higher. And it hasn't come back down and checked it. So that's one that says we should not look for this to fall because it fell back here and it never even got back inside that candle, let alone get to the gap close. But got another problem is that after that week, we're now into a new week and we need to stay above the midpoint of this week. If we don't, then we can fall down and break that, and then we're going to close this gap. And that's all bad news. So look at how the gap candle closed. Zoom in here a minute. So we closed here, we opened here, and with almost no tail on the bottom, we ran and then we started to fall. And on that fall, we closed near the mid. That little cyan line right there, that one, that's the midpoint. And look how close we closed to that mid. That's not good to close like that. Does it mean we're going to go down? No, but it's more likely to go down because it's a gap and crap, because it closed near that mid. There's a lot of things that says this is likely done and it's going to fall, but it's still defying gravity. This week, look what it did. It opened on a gap down, and if you're trading, you know that a gap down from the highs is a good thing, right? You want a gap down and a rally up. And that's what it did. It gapped down and it dipped, and now it's rallied up and it broke above last week's close. Until Google falls beneath last week's close, we don't have a short signal now. The good thing is we have a really good short signal now, right? All we got to do is close below that Friday's close, and we've got our trigger short. So where do I want to put my butterfly? If I assume we're going to break that close and fall, I would target $300. It's a big round number. It's that weekly candles gap close. And it's where I would expect price to go if we begin the fall, right? $300 would be a big, nice round number. It should have plenty of options. It should be far enough away that I don't, get murdered trying to reach it. All of those are in my favor. But the likelihood of me being right that we actually do fall down is, well, right now it's slim because we're still above that close. But that's how I reach my decision of where do I want to put this butterfly? Well, let's go look at the chart. Now I am on a weekly. Maybe we should shop around a little bit and go to the daily. There might be more information there. But at this point, I'm really happy with my $300 target. Remember what this cyan line is. It is the midpoint for this month, and it's $300, and it's that gap close. That's a lot of ands. I like to add them ands up, right? Stick them in my pocket. I don't see anything here on the daily that takes $300 away from me. I still like $300. Could I find an upside target? Oh yeah, we're forming a TRB right now. We could run right back up to 330 by Friday. By tomorrow actually, but by Friday we could get a TRB back to the top. But I like 300 better. The cool thing about butterflies is you can do both, right? You could build one at 330 You could build one at 300, and you can layer them out all over the place like a little landmine. So now we got to find a 300 strike butterfly at a cost that we like in a time that we like. Is 16 days going to be enough? That's a little short, right? 20 would be better, plus 20 would be better. But while it's better for my butterfly because it'll have more time to mature, it's not really better for my analysis because I think this whole thing's going to break down and go, right? I don't think it's going to linger for 2 months while my butterfly matures. So we have to weigh the odds of I don't want to go too far out in time against I need enough time for this butterfly to mature so that I'm not stuck with a some little 0 day, you know, uh, fighting the playing chicken with the clothes kind of thing. So here's the 300 strike butterfly that I just built. It's $7 of risk. So if we're completely wrong and have to pay commissions, we're out $10. That's a Big Mac meal at McDonald's, right? Maybe with an apple pie or something. Not like I'm hungry or anything. $7 of risk. Now, this isn't a very wide butterfly, so we could widen it out, make it bigger. If we make it bigger, we increase our risk, but we widen the window of profitable opportunity. Right now, my window of profit is that big. So if we get under 305, but we stay above 295, I'll probably make some profit, right? We can mark that on the chart, by the way. I don't have to do that by hand. On Thinkorswim, go to the show actions menu down here, set the slices to break even, choose your expiration, and then set the slices again on the chart. Oh, I was way off. Yeah, that's why we want the machine to do it. 297 and a half and 302 and a half. So that's a pretty narrow window. And if I don't land in that window, I'm going to lose. Because this has 16 days, it's likely that as price moves towards our target, it'll begin to see profit. But that's a maybe because it depends on how fast we move towards that target and how soon we begin moving towards that target. Otherwise, we could start moving towards it, and my trades just still might not be profitable until we get, say, under 310 or maybe under 307 before we start to see some profit. But like any trade, as long as price actually does get there, we'll make money. We have to get there in the right time, though. So we could make it a little bigger if we're willing to risk a little bit more money, widen the position, or we could point the butterfly with that broken wing fly or the ratioed fly, depending on which one of those we like. The neat thing is, by the way, guys, you can do iron condors this way too, right? You can point them in a particular direction. You can trade ranges. Um, you can skew an iron condor, but that's another day, right? We're worried about butterflies, and condors have a lot more risk, so they're not necessarily a better vehicle. So $7 right there. What's the expectation? Well, it's $5 wide. So if we hit max profit, it's $493 of risk, profit for $7 of risk. I do see the potential for Google to break down. Yes. But we don't have a short signal. So the idea of buying a call or buying a put for me is that's a directional trade with action behind it. See, a butterfly needs time to go by. And if we begin moving south between now and December, whatever I picked, 16th, this trade will slowly begin to make money. And if it doesn't, my max loss is $7. I will shrug $7 off any day of the week. I don't care. $7, you know? But a put says I need price to get the hell in gear and get its butt down there. The sooner the better. And if it lingers or drags its feet, then my chances of losing go up every single hour that it doesn't make that move. And which put am I going to buy? Because all of these are hundreds of dollars as opposed to $7. Now, granted, the put would make me more money probably if we fell tomorrow and ran right to 300. This $2 put would be worth $750. Not bad, right? That's a $550 profit. But we would have to make that move very fast, or I'm not going to see $750 of profit. On the other hand, I am still risking around $200 to buy that put. Since we just talked about how dangerous it is with the rate cycle and everything that's, going on out there and all of the risk that's out there, would you rather risk $7 or $200? But setting aside that, there is the question of should I buy a put or sell a call vertical or buy a butterfly? I see Google coming down to $300, but I don't see a short signal unless we break that level that I had pointed out. Let's just say 320. If we can't get back down below 320, then the short signal hasn't triggered and we can't get to 310. And if we can't get to 310, we can't close this gap. I need momentum to the downside to buy a put, and I need momentum to the upside to buy a call because long options require price to actually do something. And we don't have any signal that price is actually going to do something right now. That's a dangerous precedent that I've learned not to do in my account. Because, it's very likely that Google will go to 300 eventually. But when? Friday? Next Monday? If I sit in this thing for 4 days waiting for it to fall, my call is, or my put is just bleeding like crazy. And then it finally makes the move, and maybe it's too late. And I don't have enough juice left in that put to even make it back to profit. Now, a call vertical, if we built a call vertical up here that says maybe I don't think you'll close higher than 325, only requires price to stay under 325. It doesn't have to actually go anywhere. And if it did start to fall towards 300, we can roll that call wall down and make more money in the roll because we get to lock in profit. And so if it fell even more, we could roll it even more, lock in more profit, and we can take that simple little call vertical and double its profit during that move down. So we don't miss the opportunity to profit from the fall. As long as it doesn't go up, we would win. I do like Google for a short, but I like all of them for a short. I have liked them all for a short all year, and that has not um, worked out very well, right? Because it's just been a wild year with this bullish exuberance. Microsoft had really bad news today, and it's trying to recover from that bad news even right now. The close is lower than the previous day's close, but it's higher than the open. You can see how we're trying to recover already. Oh no, it's breaking the wedge. Ah. So if you're shopping around for a trade, one of the things that you could think to use for your approach would be what kind of trade am I looking for? A momentum trade, a line in the sand trade, low risk, low reward, low risk, high reward, right? Like you can really dial in the kind of risk that you want. And I think diversification is a really good approach, right? Like I like all kinds of risk. And depending on the market backdrop, I want all kinds of risk. I don't want a whole portfolio full of these low risk, low reward trades, right? Because that would just really suck. And I don't want a whole portfolio of low reward, high risk trades either. You know, you got to kind of spread it out a little bit. So once you decide what kind of risk you're looking for, what kind of move you're looking for, then you got to have a pool to shop from. My niece is looking for a car right now. She just graduated. She's young and she's not a mechanic. She doesn't know much about cars. And she was looking at that app where you can buy cars. It wasn't Carvana, it was an app like Carvana. And she was looking at, give her credit. She was looking at Toyotas. And of course, there was a Saab in there. Um, I mean, she wasn't looking at Porsches or anything, but she was looking at some high end cars. And like I think you need to dial back your pool of cars that you're looking in because those are all a little pricey. Look at the trades that you're shopping around for in the market environment that you're shopping in right now. I think we would all agree this is a pretty high risk environment. You maybe don't want to take some of those high risk trades, high loss reward, high risk trades. Risk as in it might lose more frequently, but risk as in, wow, that's a lot of money at risk. Which is why having a diversified watch list of cheap stocks and your mid-priced stocks and then your very expensive stocks, that'll help you out to be able to, aim towards different values with different risk parameters. Buying calls and puts are going to be more expensive. Yep, you do absolutely. You got to buy the time too. And that makes it even more expensive, right? Because time is money and theta is expensive, and that makes the cost of the option go up. So while I don't like penny stocks because the options on penny stocks are just absolutely horrible, there are cheaper stocks that I like, and I break them down into groups. Airlines aren't bad. There used to be a couple of decent pot stocks to play. Gold miners aren't bad. We're talking about, the low end stocks. Um, Ford, GM, those guys, but there's no premium in those, right? So like if you're on the sell side, AT&T and T and Ford and GM, you never want to sell those to open unless you're doing like butterflies or something because there's just no There's just no money there. But you know, you you put together a trading environment that suits your level of risk, and then you know what basket to be shopping around in. And then when you have your basket built, like me with the airlines, when we get into holidays or we start to see headlines and we say, "Oh wow, check it out, the airlines, they're getting flow." Perfect. Because this is a risky environment and airlines are cheap and they're in my quote cheap to play list and they're getting attention right now. That's the perfect time to trade them because it suits my needs and they're getting flow already. JB Hunt, transports, industrials, those guys are getting attention right now. Um, in a rate cutting cycle, if we do go into automatic mode and start cutting 25% every time, staples are actually going to come back to life. So we'll be looking at like Pepsi and Costco, BJ's, um, yeah, staples, right? Kroger, just it's just the way it goes, But Pepsi and Kroger and those, they're Kroger maybe kind of cheap, but Pepsi's not so cheap, right? Kroger, I mean, it's less than $100. Not airline price, but it's not bad. I have been long Pepsi all year. All year. I bought a call like way back here in January on I think it was this double bottom, this inverse cup, I should say, not a double bottom because it didn't exceed the previous low. But I've had a call for January, I think, February of next year, and I've been carrying that call all year. All year. One, I think that call was $25, and I mean 25 cents, $25, right? So worst comes to worst, after a whole year of carrying it, I was going to lose at most $25. Two, I've sold options against that long call multiple times now, and I've made my $25 back. So I just still carry that losing call, and it's such a loser. That thing is, it's toast. But what do I care, right? I already made my money back on it. And here I am still looking at Pepsi, 9, 10 months later, damn thing still a turd. I didn't make a dollar on that call, but I made money back, it's all right. We might actually be getting close enough to it where I could try to make a little bit more on it. We got too far away, and then I couldn't sell a call to make any money on the call that I had. Because that's the nice thing about options. I had that long call. It was a complete turd, just a loser. And like, well, I mean, I already got it and it's already lost. There's no reason to cash it out. I might as well hold on to it and make some money off of it. And that's just one trade one time, right? But you start stacking up, you get, 275, 325 trades that are all diversified in different types and different styles, different risks, different expirations. It keeps you busy enough that you're not hunting for new trades every minute of the day. There's my Pepsi trade up there. $25. I thought it was 20. I guess it's 25. As you can see though, it's a loser, right? And it still has 44 days to expiration. I've been in it for 316 days. I've had this thing all year and it's just been a turd, right? 250 is the strike price on that. When we got even remotely close to it, I would sell a call against that and turn it into a short call vertical. And then that short call would decay and I'd buy it back and then I'd sell another one. But we fell too far and then I couldn't even find a short call worth selling, right? We were all the way down here in the 120s. So yeah, we're back in the 150 area. I've got a 250 strike. Maybe I'll make a little bit more money on it. But the main thing is I didn't lose any money. So what do I care? The brokers made money because they got commissions on my trades. I paid that off. I don't have any risk. Remember, one trade one time isn't the solution. You can't make the bank, get it all done at once. You just spread your risk out, find opportunities, and find ways to reduce your risk where you can. So, here's an example of what I was doing. Now, this isn't going to work because, look at all these are all bag holders. But say I want to pay this $25 off. I could sell um, this one for $36. As long as price closes underneath that level, or if we stay underneath that level long enough for this option to decay, I buy it back cheaper than I sold it and I make money on it. Then I can do it again and I can do it again and do it again because I've got all year to do it. And all I got to do is make that $25 back, which I already did. I'm not even worried about it. It's just the idea that we can trade whatever we want, but I like to focus on ways to reduce my risk or have a plan on a way to reduce my risk. And then I've got a path towards taking a trade. If I can't see a way to reduce that risk or manage it in some way, then I really find it hard to get to the point where I want to pull the trigger because I don't like living in that environment where we have to be a winner or a loser, as demonstrated with the Pepsi, right? That Pepsi is totally a loser, but I already made my money back, so it doesn't matter. It takes a little bit of time to put together your lists, but it is worth the time to put together your lists. I know a lot of people do it by industry or sector. That can be a little more to chew on than you might be ready for. So you can do things by the index. Um, I really like the Dow Jones, especially when it comes to new trading. A new trader can look at the Dow Jones and have a very diversified trade portfolio, longs, shorts, different sectors and different industries and different stock prices, and a lot of household names wrapped in there. To be fair, the Dow also has more expensive companies too, right? I mean, there's a $40 stock, which is Verizon, but most of these stocks are pretty expensive. Nike, which is a turd, anyways, Coke, Cisco. So wow, four names less than $100. After that, the price goes up. But you could pick the S&P 100, the Nasdaq 100, and shop around in those, and then kind of group things into the categories of price that you're looking for, and then match that with liquidity. It works out pretty good. That's such a short signal, but there's an old rule of thumb when it comes to trading that is wise advice to pay attention to. Never short new highs. Never buy new lows, right? So when you have a stock breaking out, the prevailing swing trade wisdom, because of course, day traders or very short term traders, we can do what we want. But we're talking about those longer term trades. You don't want to short new highs, especially all time highs. It's just a bad approach. So Google fits that, right? Big, beautiful gap up after already being at the highs. We know that that's failure. It's called the gap and crap for a reason, but it hasn't triggered to me. It hasn't triggered yet. It has to at least close below that midpoint. If we can do that, then I can at least argue that I've got a short signal, the wick from the previous week, and then the gap down and the run up was just to close the gap down. And now that we've closed it, we are free to go and we can get short after we cross the midline of the previous week. Then the price targets would be getting to this week's open, this week's low, last week's open, and then into the channel to close the gap, level by level, baby. And I had to run it all the way back down. That is when we would buy the put, right? When we actually get short triggers and can take it because it's running. Until it does that, if you still wanted it, then short call verticals or butterflies would be the appropriate way to go. So Apple had headlines. They're talking about their phones. Um, I don't want to misquote the headline. So, well, that's bright. Make sure I get this. Oh, yeah, sure. Now I'm going to go look for it and I can't find it. iPhone 17 to drive record Apple shipments in 2025. Okay, I mean, that doesn't really give us a preview of 2026, but that is almost or a little over a 6% increase year over year. I don't know if any of you are Apple users. I am. My phone, my watch, tablet, all of that. But Siri sucks so bad, like really, really bad. So I'm a Google user when it comes to my household. Um, I use the Google Dot, and on my phone I talk to Siri or I talk to Alexa. I don't even mess with Siri because Siri's an idiot. I think that in 2026, if Apple resolves its Siri issue, like they keep saying that they will, that stock's gonna moon, baby. It's the only thing holding them back. It is hard to argue with any analyst right now saying that the AI valuations are way overblown and there's just no way for these companies to make their money back at this point. I can't argue against that one bit. But how long is it going to take before the market decides to punish these companies for the expenses that they've been piling into AI? You know what I mean? Like it could be next year, it could be 5 years from now, for all we know. Eventually, the music's going to stop and somebody's going to be without a chair, but that could be a long time from now. I clicked on this Apple article because usually people hate on Apple when they're at the lows, and they don't hate on them when they're breaking out and pushing. So I was surprised to see that someone was hating on them like that. But that's blue skies. We don't want to short new highs, and that was a gap down to run higher, not a gap up at the highs. We are 1236, so we're looking for OCC here. I would not buy a call, right? Because we're expecting this to digest now, at least one OCC. We do have employment tomorrow. I'm a little at odds with the economic data. The dates are a little off, the times are off, and what I'm missing for Friday is non farm payrolls. So it's like, where the heck is our jobs data? We are going to get jobs data tomorrow, the initial jobless claims, and that's a Thursday thing. So it's right where it's supposed to be. But where the heck is non farm payrolls? I wish I had an answer to that, but I don't. This is a publication from Macro Micro with Yardini as one of the highlights. Right, Yardini's an old man. He's been around for a long time. He um, he coined the phrase "the Roaring Twenties" again, as in like the 1920s, but it's again, so it's the 2020s. And this guy has been bullish the U.S. markets since COVID, when we were rallying out of the COVID lows. He was like, "Yeah, baby, the S&P is going bullish for the next 10 years." That's a bold statement. Why you keep hiding from me? Huh? Why? Porque way, pinche. Wow, it's so bright. Dark mode. Thank goodness. He says his base case outlook calls for a continuation of the roaring 20s scenario next year with ongoing productivity gains that fuel higher. I'm going to choke slam you, you dirty dog. Which propels earnings in the stock market higher. Now, in this, which I'm going to open it in another publication and see if that stops the disappearing act here because it's driving me cuckoo. I open it over here. It's fine. Seriously? The heck out of here, dirty dog. Anyways, let's get to where I came over here for. Yardini research. Yep. This is real GDP and when we had recessions in that GDP forecast, right? So you can see in the 80s that drawdown here, and in the 90s, and then here the 2000 and the financial crisis, COVID here. So the gray areas mark out recessions, and this is real GDP, right? It's hard to understand why our government is trillions in debt with that sort of GDP, but whatever. Not not pointing any fingers. And this is personal consumption expenditures and real disposable personal income per household with recessions in the gray area. Now we had that bump in disposable income because of the helicopter money, right? Remember they people got their stimmy checks. Give me my stimmy. And then they blew it all, and now they're running hot again. Corporate profits from current production before taxes and after taxes. Corporate profits after taxes. And the S&P. Now we have a 4 to 7% CAGR path. The bear markets are marked in red, and you can see that most of the time we're not in a bear market, right? Just little dips. Otherwise, it's just up and to the right, with the worst case scenarios being those time frames where we are inside of a major range, like from 2000 to 2012. We were just in this real big, wide megaphone pattern, but we finally came out of it and it's been up and to the right since then. So for those longer term buy and hold accounts, I mean the path is clear. I have an account at this company here. It's called Macro Micro, and they are connected to Yardini and his research, and I downloaded it from here under, where is it at? I think it's in Spotlight right now, but it's in this scroll wheel. So if I just run back one, here's his publication. These guys, if you pick up this subscription, it's gonna look like Chinese writing when they hit your account. I wish I was making that up. I'm not. The first time they billed me, I thought I had gotten hacked. I was like, "What the hell is that?" But I knew I had just pulled the trigger and bought this, and then it hit my bank, and so I was like, "Okay, I'm not hacked, but man, that's scary." To see some bill pop up on your debit list or whatever, and then it's in Japanese or Chinese writing, and you're like, "Oh no, no, no! What is this? It's not good." It's a fantastic service, but it is very deep stuff, right? Like, this is where most of my education has been looking, my own personal education. I'm growing as a trader like anybody else. Learning the macro side has been a lot of work. And I learn from this rather than going to get a college degree in economics. But they have some fantastic tools. So Yardini, anyways, back to that. He is still highlighting a lot of reasons that sure, we've got bricks in the wall of worry to be concerned with, but at the end of the day, um, as long as it ain't broke, it's going to continue to run. You know. Oh, that. Thank you, Siva, for reminding me. I honestly I had forgot, but I'm back to it now. Someone asked about this company here, Options Strat, and what do I think of it? I've got so many options tools that I use for different reasons. And a lot of those tools I have for free, so I mean, I don't look a gift horse in the mouth. I I'm not going to turn it down. I don't have this one, so I don't use it. Would I spend money for it if I did not already have it? I don't know. I have checked it out before. I thought it was very the visually appealing. It's nice. You don't see a lot of places put the effort in to have these colored risk profiles like that and to make it so clear and easy to understand. I really like it. But that's for that side of it. Do I think their scanners are good or that they're, you know, uh, dialed in to catch the kind of flow that we need? I haven't I haven't had a chance to use their scanner live to be able to answer that. I do know that this is pretty amazing when you can find a risk profile that looks that clean and that real. That's easy for traders to understand as opposed to the raw ones like on Thinkorswim where it doesn't have the color behind it and it's harder to learn what those profiles are. And they even have the jade lizard. It's rare for that, right? Cuz like that's a new options trade designed by Jen and Lizzie over at Tasty Trades. Most places don't even know what the hell that is, and they've got it built into their system, which is awesome. For a monthly service, $80 a month is a little much. So, since I haven't used them myself, here's something to keep in mind. For $80 a month, that flow better be live right now, no delay, raw data feed. I don't want to see some aggregated, collaborative, in-house metric. I want the raw data if you're going to charge me $80 a month. And I don't want any delay. A lot of these places, they'll put in like a 5 or 10 minute delay. Not for $80 a month. They better not. Then, do you have the opportunity to adjust the scanner settings? Some of these places will not give you 0 day, for an example. Or like other places, they'll only give you 0 day and they won't give you any of the broader metrics. I'd want to know what I'm getting for my $80 because it has to stack up against something like Trady Ticks or Spot Gamma, Cheddar Flow, Black Box Stocks, Option Samurai. That's another one that does a lot like what these guys do. I could make another email and run that free trial and see. See how it's visually doing all that work for you. That's nice. And if they are doing call alerts with this machine to where they point out call flow or put flow and they recommend, you know, a trade, then they should have a statistic for how well their trade recommendations have been working. If that is their justification for $80 a month or 70, and they say, yeah, but we call out trades and that, fine. What's your success rate? It would be good too for $80 a month. Do they have a Discord? Do they have a dedicated trading community? People that, use this thing every day and they lean on it. Most of the places that I know, they've got a guy, or they got a person, a lady, somebody that is the one that everybody looks to on how to use it. They see them using it every day, they're actively engaged with it. If they're just going to throw a platform at you and they don't have a Discord and they don't have anybody demonstrating its use and showcasing its profitability, I find it hard to pay $80 a month for this service because you could go to somebody like TradingTix. But it is a nice looking platform. Can't argue against that at all. Also, I noticed I'm not seeing dealer positioning, right? They've got the options flows, obviously, but I'm not seeing dealer positioning. Me too. I need to wrap it up. I get sitting here chit chatting all night long and start to get the stink eye from the old lady. She's gonna get hungry, and then I'm gonna be in the doghouse. Futures data is delayed. There is no options data delay if it leave the futures out of it. Options aren't delayed. You can save your filters, set alerts, has mobile. I I didn't see. I don't like this either. Delayed. I didn't see anything in here. Oh, that was for if we had the free features. Never mind. My bad. I don't see why it's worth $80. So I hope that helps. I think you could do something better. Um, Something like Tradie Ticks at the bare minimum would probably be better. This looks pretty, but look at what they're offering you. I guess if it's the same price as Tradie Ticks, or if it's cheaper than Tradie Ticks, I don't know what Tradie Ticks is costing right now. Maybe it'd be worth it, but it's just options flow. 0 day options flow. You got options flow right here in the Discord if you want that. And it won't even cost you anything. Just go down to the Discord channels. And if it's unusual options activity, that's what we call this, UOA, unusual options activity. And that's a niche trading style. They say you can use it in swing and they're not wrong, but most of the UOA that we get is not swing trade signals. They're day trade signals. You're in and out, and they're one and dones and you move on to the next one. And you're capturing, like 30% if you're really lucky. Otherwise, you're hitting, base hits. Nothing wrong with those. 15 to 20% profit on an option and you cycle it out and get another one and another one. If you're running a small account and you're fighting PDT, this is not your vehicle, right? Don't do it. It'll run you right down the rabbit hole. It's a tricky business to trade 0 day um, or Friday expiry unusual options activity, and you can't fight PDT. So make sure your account is over 25K or don't lean in this direction. Hope that helps. All right, everybody. Have a good night. I'll see you all in the morning. and we'll get through that employment data. We'll see what we got after that.